It's 2039. Markets still work. Bloomberg screens still flicker. Charts still rise and fall with the hypnotic rhythm of daily volatility. The exchanges still open right on time at 9:30 a.m. in New York, following the same century-old ritual that defines the heartbeat of global capitalism. Banks still operate. The glass towers of Manhattan are still lit late into the night. Traders still shout. Algorithms execute millions of orders per second. The financial system, at least its visible architecture, looks intact. But something fundamental has changed. No one uses the dollar to trade energy anymore. Oil contracts that were priced in dollars for decades are now settled in yuan, rupees, sometimes even in baskets of commodity-backed digital currencies. Food, wheat, soy, corn, moves between continents through bilateral agreements that simply skip New York. China builds ports in Africa, paid in renminbi. India finances railways across Asia in rupees. Europe negotiates gas with the Middle East in euros. The dollar wasn't banned. No international decree toppled it. No dramatic crisis destroyed it. It simply became unnecessary, like a language that fades generation after generation. It still exists in books. It can be studied, but no one uses it to communicate anymore. And the most disturbing part? This process started decades earlier. Not in 2039, not in 2030, but back in the 2020s, maybe even earlier, in the years after 2008. No alarming headlines, no public panic, no visible crisis. It began with a single indicator, a simple number almost no one watches, but one that determines everything. Calm down. This hasn't happened yet. It's 2025, and the dollar is still the world's global currency. Wall Street still sets the tempo. The Fed is still watched with near-religious attention. But every major monetary empire fell using this exact script. Rome. The denarius didn't collapse in one day. It slowly lost purity, credibility, circulation at the borders, until merchants simply preferred other forms of exchange. Spain. The real de ocho dominated Atlantic trade for 2 centuries, but it was quietly displaced over time, as New World gold fueled structural inflation that eroded reliability. The United Kingdom. The pound sterling, undeniably the world's currency in 1900, holding more than 60% of global reserves, didn't fall because of world wars. It lost ground gradually, transaction by transaction, until Bretton Woods simply acknowledged what was already true. The dollar had taken over. None of them collapsed on the day the currency fell. They collapsed when the currency stopped circulating outside the homeland, and today the same signal is flashing again. Over the next few minutes, you'll understand. First, what indicator always comes before the collapse of hegemonic currencies? Not inflation, not debt, not deficits, but the one number that truly determines hegemony or terminal decline. Second, why this indicator matters more than any traditional economic metric. Third, where exactly the dollar has begun to lose function. In real transactions, concrete deals, operational shifts happening right now. Fourth, why it's not in the headlines. Why the most important change in financial geopolitics is unfolding in silence. And fifth, why once this indicator crosses a certain point, there is no return. This isn't prediction, it's a historical pattern. Common belief: the dollar only falls if the US collapses economically. The logic sounds reasonable. The US has the largest economy, the most valuable tech companies, the deepest capital markets, the most powerful military. As long as that holds, the dollar must be safe. Reality check. Completely wrong. Hegemonic currencies don't fall because of internal crisis. The pound survived the 100 Years' War, the English Civil War, and 2 world wars on its own territory. Hegemonic currencies fall when the rest of the world finds alternatives. When Chinese and Brazilian merchants realize they can trade directly. When oil producers discover they can sell to Asia without touching dollars. When central banks diversify because dependence on the dollar becomes a risk. The dollar's power was never just the U.S. economy, it was the dollar's global function, its indispensability. Function creates demand, demand creates power, power preserves function. A virtuous circle, while it works. But function can be replaced. Today you'll see the indicator that determines whether a currency is hegemonic, where the dollar is losing ground, quietly, the historical point of no return. What happens once the number crosses the critical threshold? How to spot the process before it becomes a crisis. This is not an alarmist video, it's a structural one. The name is simple. The dollar's share in international trade and global reserves, not the dollar's exchange rate, not the DXY, not daily price movements, but where and when the dollar is used. Historically, 1945, Bretton Woods. The dollar takes the global role out of practical necessity. The U.S. exits World War II with the only major economy intact, half of global GDP, and 75% of the world's monetary gold. The dollar becomes convertible to gold at 35 Aus. Reserve share rises above 70% quickly. 1971. Nixon closes the gold window. The U.S. announces it will no longer convert dollars into gold. Many predict the immediate end of dollar hegemony. But nothing happens. Why? Because the function was already established. Oil contracts were already in dollars. The infrastructure already existed. The world kept using the dollar, no longer backed by gold, but backed by trust and inertia. 1980-2000. The absolute peak. Globalization accelerates, and virtually all global trade runs through the dollar. Reserve share remains above 70% for decades. Near total dominance. Post-2008. The erosion begins. The financial crisis shakes confidence. The world watches the heart of the American system seize up. And China, emerging as the world's factory and the largest trade partner for 120 countries, starts asking a simple question. Why do we need dollars to trade with our partners? Today, in 2025, what matters isn't how many dollars exist. It's how many transactions can avoid them. The dollar's share of global reserves has fallen from roughly 70% in 2000 to about 58% today. 12 points may not sound like much. But in monetary hegemony, it's massive. It's the difference between unquestioned dominance and contested primacy. Verifiable facts. First, global reserves. The dollar's share fell from 70% to 58%. This wasn't a bank run. It was a gradual reduction quarter after quarter. Where did it go? To a diversified basket. Euros, yen, pounds, francs, yuan, and increasingly physical gold. The IMF publishes this data quarterly. Anyone can verify the trend. Second, bilateral trade in local currencies China and Russia. In 2015, about 90% of bilateral trade was in dollars. By 2024, it fell below 25%. Most trade now settles in yuan and rubles. China and Brazil. Brazil allows direct settlement in reais and yuan. Why? Efficiency. Why convert reais to dollars, pay spread, then dollars to yuan, pay spread again, when you can exchange directly? India and the Middle East. India buys oil from Russia in rupees, trades with the UAE in dirhams and rupees. ASEAN. Southeast Asian nations are building regional payment systems, allowing settlement in local currencies without touching dollars. Each deal is small on its own. Together, structural change. Third, energy outside the dollar. This is the most significant. For decades, oil meant dollars. The US-Saudi arrangement in the 1970s created the petrodollar. But in 2023 and 2024, Saudi Arabia signaled openness to selling oil in other currencies. China buys oil in yuan through Shanghai contracts, Russia sells energy in euros and rubles, Gulf countries trade with Asia in local currencies. The dollar's monopoly in energy pricing is cracking. Fourth, gold central banks are accumulating gold at the fastest pace in decades. 2022, over 1,000 tons. 2023, over 1,000 tons. 2024. The trend continues. Who's buying? China, Russia, India, Turkey, Poland, Hungary. Why? Gold isn't issued by any government. It can't be sanctioned. It doesn't depend on any banking system. The interpretation. None of this is ideological. It's operational, practical. Countries are learning they can operate without the dollar in many transactions. And when they can, more and more, they do. Using dollars has costs. FX conversion costs, double spreads, policy risk, exposure to the Fed, political costs, sanctions, and surveillance. When alternatives exist, those costs become avoidable. The system isn't attacking the dollar. It's learning to operate without it. 1730. Phase 2. The logical projection. If the trend continues, and incentives suggest it will, what happens? In 10 to 15 years, the dollar still exists. The US remains strong. Wall Street keeps working. But the dollar stops being mandatory. You can buy oil without it, trade internationally without it, hold reserves without relying on it. Demand falls structurally. When the dollar was mandatory, demand was huge and artificial. Countries held dollars not because they wanted to, but because they had no choice. When it becomes optional, forced demand disappears. And US fundamentals include debt above 100% of GDP, persistent fiscal deficits, and current account deficits. When demand was forced, deficits were financed easily. When demand becomes optional, the US must compete for financing. Interest rates rise, costs rise, living standards face adjustment, sanctions lose effectiveness. Sanctions only work if the system you control is indispensable. If alternatives exist, if China can trade in yuan, if parallel systems operate, sanctions become inconvenient, not fatal. The cost of hegemony rises. Maintaining hegemony is expensive. Open markets, trade deficits, global bases, crisis interventions. When benefits are obvious, cheap financing, easy funding, sanction power, the costs seem worth it. When hegemony weakens, but costs remain, the equation changes. The critical point, a hegemonic currency only works while it's inevitable. Monetary hegemony is all or nothing. Either you're the standard or you aren't. When it's inevitable, network effects strengthen. Everyone uses it because everyone uses it. Virtuous cycle. When it becomes optional, the cycle flips. Some stop using it, making it less useful for others, who then stop using it. Vicious cycle. And the transition isn't linear. It's exponential. It starts slowly, then accelerates. When it becomes optional, the system changes. Project 15-30 years ahead. Countries hold dollars only for liquidity. The dollar doesn't vanish, but its function changes, from essential strategic asset to optional liquidity asset, like euros or pounds today. it stops being special. Real trade happens in regional blocks. Asia settles inside a yuan-led basket. Europe consolidates the euro. The Americas grow local currency trade. The world doesn't fully fragment. It regionalizes. Parallel payment systems become the norm. SWIFT is Western-controlled, but alternatives emerge. CIPS, China, already processes trillions. SPFS, Russia, operational since 2014. Instex, Europe, to bypass sanctions. CBDCs, dozens of countries testing digital rails that connect directly. These systems create redundancy. Alternatives, a world where being outside the American system is no longer fatal. The U.S. loses exorbitant privilege. For decades, the U.S. could spend beyond its means, run chronic deficits, print through crises without catastrophic inflation, and finance massive military budgets at low rates because the world needed dollars. When the world doesn't need dollars, costs rise sharply. Rates must rise. Inflation becomes a real threat. Deficits become harder to fund, not collapse. Adjustment. Painful adjustment. The world becomes monetarily multipolar. No single center. Yuan serves Asia, euro serves Europe, dollar serves the Americas, gold becomes neutral reserve. CBDCs enable direct settlement. It becomes more complex, more fragmented, more unstable, because multipolar systems are inherently less stable, more friction, more negotiation, more disputes. The period between hegemons has historically been turbulent. The pound-to-dollar transition included 2 world wars, not because the transition caused war, but because it created power vacuum. The dollar won't collapse. It will retire, like the pound sterling. The pound didn't die. It stopped being global and became regional, gradually across 1914-1970. The dollar is following the same path, from hegemonic to important, from essential to optional. Currencies don't die in crises. They die in silence. Crises are symptoms, not causes. The pound died through 1,000 small substitutions. The dollar is dying the same way now. The historical point of no return. When a currency's share falls below 50% of global reserves, not arbitrary, repeated pattern. The pound sterling, 1913. 60-65% of reserves, undeniably global. 1920s-30s, declines but stays above 50%. 1944, 55-60%, still dominant. 1950s, falls below 50% and never returns. 1960s, keeps falling. 1970s, below 20%. Today, under 5%. Why 50% matters. Above 50%, natural denominator massive guaranteed liquidity network effects self-reinforce, leaving costs more than staying below. 50%. No longer default alternatives have critical mass network effects turn against it. Leaving becomes easier. It's an inflection point. Network math creates an irreversible downward spiral. Once the system learns to operate without you, it doesn't go back. And today, we are dangerously close. Dollar share, 58%, 8 points above the critical line. Decline rate, DOM 1 point per year. Projection, 8 to 15 years to cross 50%. But declines like this often accelerate. The curve isn't linear. We are in the critical phase, not the crisis, but the phase that precedes it. Perspective. This does not mean immediate collapse. It means a power transition, a structural shift. The U.S. remains strong. Major economy, dominant tech, elite universities, innovation, military strength, deep capital markets. None of that vanishes if the dollar loses hegemony. The UK didn't collapse when the pound lost hegemony. It remained wealthy and influential, just no longer the center. But not unique anymore. From 1945 to 2025, the US was the uncontested center. That's shifting toward multiple centers, multiple currencies, multiple payment rails. For some, positive, more choice, more competition. For others, negative, less privilege, higher costs, but not collapse, adjustment. The real risk isn't the dollar falling, it's the world operating without a clear center. Hegemonic systems are stable, clear rules, institutions, a lender of last resort. In 2008, the Fed stabilized not just America, but the world. In a multipolar world, who plays that role in the next crisis? Systems without a center are unstable. Between hegemons, history tends to be chaotic. That's the risk. Systemic instability in a world without a clear monetary leader. Recap: the indicator. Share in global trade and reserves. The dollar. From 70% to 58% in 2 decades. The threshold. 50%. Below that, no hegemonic currency has ever recovered. We're 8 points above it. The indicator isn't screaming, it's whispering. In IMF reports few people read, in quiet bilateral deals, in central bank gold purchases, in alternative systems growing in silence. History teaches whispers come before noise. In 1910, few saw the pound's final decades. In 1960, few understood Bretton Woods was already broken. Today is one of those moments. Future generations will say, it was obvious. But it isn't obvious while you're inside it. Now you know what to watch, where it is, what it means. That gives you perspective. But one final question remains. When the dollar crosses 50%, where does the money go? Not the dollar, not the euro, not crypto. Something older, something that can't be printed, can't be sanctioned, doesn't depend on any government, something that for 5,000 years has been the final refuge when monetary systems fracture. Next episode, we break down why this asset is different, why central banks bought over 1,000 tons in each of the last 3 years, how it behaves during hegemonic transitions, how ordinary people can position before the acceleration. You probably already know what it is, but you may not understand the role it plays, and why this time it may matter even more. See you in the next episode. And until then, pay attention to the whispers.